All right, so weekly and closing thoughts on the S&P 500, oil, HYG, credit spreads, high yield growth credit spreads, long-term corporate credit spreads, the forex with euro, the Japanese yen, the US dollar, and the VIX. So S&P 500 closing thoughts. Institutions are long for the most part until they flip short, and I think it has to do with the traps. The traps being, if we were to take a look here on the weekly, this is the bear trap. We wicked below. If we closed below, then it would be a continuation. But we got caught and swept up. This acted as a bear trap on this week, this down week. We closed and we touched the very bottom of this moving average channel, and it caught all the bears off guard, including me. I didn't really start implementing this until we had this this whole debacle, and where everybody was bullish, and then whoops, nope, it's time to readjust. Like getting over these long-term moving averages, like the 150 and the 72. They're great for a bias in just terms of, I don't know, I guess long-term bias. But when it comes to trading, you want to do it by risk to reward, and the best way to do that is through the traps and trapping people. And here on the short side, we wicked below, and we wicked up, and so we closed above the moving average channel low. Risk to reward, we have a better reward and lower risk to go long than it is to go short. If we go short, there's not a whole lot of room. So that's why it looks better to long than it is to short, and that's the beginning of the thesis of a second leg, including the institutional bias being long. And on top of that, we have a fair value gap. So on the daily, we have a fair value gap, and a fair value gap is taking an engulfing candle. So here, this is the engulfing candle, this candle. We take the wick of the previous candle and of the low, and then we take the wick high of the candle after the engulfing candle, and we connect them, and it creates this pocket that hasn't been touched. And the idea is that there's a whole bunch of buyers that went long thinking that this is going to break out and be the start of a rally, and they got trapped. And the whole idea is the price will come into it or get rejected off of it and keep those people trapped, and then people will sell at a loss. It's either they'll sell at a loss or they'll be able to break even. And it will either fill the gap or will straight out get rejected from the gap. I have no idea what's going to happen. I just know we're going to go to here specifically. We'll see. Most likely we could fill the gap, but I don't know how long that will last, because there's a whole bunch of resistance up here. It's a two weekly resistances, so a lot of bears will be able to jump in here full strength. It'll create like a rising wedge. But it might be that way, to where there's a rising wedge all the way till 2023. And then the yearly open picks up here, and then it drops like a rock. That's, I don't know. Like, to me, I mean, that's possible. If we were to do it based off of the news, maybe next week we pump and dump within the same week, or we even have a lower high here below the 150, kind of like a official reclaim of the 150 to the downside. Like, to me, that makes kind of the most sense, because we have like a naked H4 breaker here, and I think that's like in the middle of the fair value gap. So this is right here. And I don't know, I really like these untested H4 breakers. They act as like a liquidity magnet in some ways. And there we go. It's right at the 150. I could see us waking above the 150, getting rejected, and then coming back down. And that's kind of just my weekly closing thoughts. I'm long until we hit the 150 for a reclaim and then rejection off the 150. I don't think we could fill the fair value gap, but I don't know. I'm having a hard time believing that we're going to fill the whole fair value gap. I almost think we'll fill partially the fair value gap on the daily. Yeah, there is no hard and fast rules to the fair value gap other than it's a magnet because there's a lot of people that want to get off the train and they're waiting patiently. So they'll hold up price by not selling. But then once price comes into it, they'll probably sell. And the fundamentals are bad enough to where it makes sense dumping the shares that you bought near there because it doesn't look strong. It looks weak. So we'll see. But for the most part, the economy looks sick. And we'll go over the macro. We'll go over the macro after all this. This is kind of like a summary of the macro. So that's the closing thoughts on the sp500. We'll go to oil. We did basically both of these because we put in the H4 breaker inside here. And we kind of put it all together. It looks like right around here, this weekly resistance for the most part, and the 150 moving average and the traps makes sense why it could go up here. And if we were to put on just the traps here, it would be similar. Like the top end of the trap would be at this weekly flip from support to resistance here, and then on the low end, looks like weekly resistance right there would be a good spot to get rejected at. So that's kind of just the long and short of it of the sp500. Oil. So oil is not my friend. I have to... Oh no. This is... I don't know what I've been typing differently. So, weekly resistance is still holding. That is the good news. So there's a bear squeeze on oil, and if we close the week above this weekly high, then I'm in trouble. But for the most part, I think as long as the weekly breaker stays in place, I'm okay. But it's trying to really trap and squeeze out the bears on oil. So my goal is just to hold on. We'll see coming at the next weekly close what happens, but it's getting more and more likely I want to drop the short on oil. But the close on the week gives me hope that this weekly resistance will hold until I've been given evidence that says otherwise. We close the week above on 80 spot 68. But I'm hearing news that the supply of energy with either natural gas and oil are the winter is not as harsh in Europe, and they're having some reserves. And then here in America, we're having a really harsh winter, but and then we also have reserves because the demand has been squashed. So it's like a really interesting phenomenon. I really equate it to the bullwhip effect, but yeah, I think there's more downside for oil. I mean, weekly market structure break to the downside hasn't been stomped out yet. The fundamentals as far as the seasonal makes sense, and also in terms of the rate hikes to squash durable goods with buying new cars or consuming more. I mean, if you just look at retail, and their risk of consumption is a lot less than normal. Just looking at consumer staples versus discretionary, it says a lot. And also just looking at freight and travel stocks, they don't look that good either. whether it's FedEx, UPS, or just the rails or whatever. It just doesn't look good. So oil, still holding my short until things change. Specifically closing the week above 80, spot 68. All right, so that's oil. Credit spreads is like the thing I'm really interested in, just because we're seeing like a lot of interesting things. So we're in the bull trap and bear trap. Like as you can see, the blue lines, the blue line on the bottom is for the bears, for trapping the bears, and then the long-term bull trap is here. So we're really interested at the break on the weekly market structure, which we did already. So it looks like it's falling apart in slow motion. If we were to take these away, specifically, at the down candle before the upswing, in terms of supply and demand is the down candles. And this down candle that was holding up price for 1 week, 2 weeks, 3 weeks, 4 weeks, 5 weeks, has broken on the 6th week, and the 7th week retested and now could resume. So I was thinking about dropping my Covey short positions, but this credit spread failure to hold weekly support makes me want to hold all the positions, even though we might have an up leg. So it almost seems like the up leg could be short-lived, and we could end up closing the year a little bit lower. That's kind of my suspicion now after looking at the credit spreads versus just only looking at the S&P 500, because the credit spreads tell me a lot as to like the future direction of just where things could go. So if the S&P 500 goes up, but the credit spreads, the high yield growth credit spreads, the smart money goes down, that is a divergence to where it's saying that credit spreads are leading the way and that the bulls of the S&P 500 are wrong. And we're going to see an increasing divergence of the credit spreads or smart money going down and the S&P 500 making that second leg up to where those people who are trapped as bulls can get off. And then long-term corporate credit spreads, we also broke weekly support, which held for pretty much 2 weeks, and then on the third week it broke. And I think, that's pretty much the end of the story there. We don't need to look at anything more. Okay, and then now currencies. So one thing was that the euro broke out on the week, and it looks like we're holding so far but beneath the yearly open. So I don't know. Maybe this is the new resistance, and this is like a no man's land, but it looks like it's trying to form a bull flag. But we're gonna find out just kind of what's gonna happen. I know Lagarde has decided she wants to hike rates. The inflation's bad, and I don't know. She wants to attack inflation, so she's hiking rates just as hard as Powell is, and we're in this like unified global recession, or a synchronous recession. But for the most part, I'm thinking this is a fake out deviation, and we'll get back below and close below 1009.6 on the euro. One thing that's interesting is we're having lower high daily closes. So this daily close is lower than the previous. It's showing that on a daily closing basis, not a weekly, that we're having lower high closes until proven otherwise. So I usually only like to stick to the weekly analysis and just throughout the week just kind of see where we're close to. But because this is looking like very hard to discern on a weekly closing basis, We want to see if we get any closes above this 115.9 level. And then the weekly, this is the weekly. But yeah, like that's pretty much it for the euro. And then Japanese yen. Japanese yen, we closed the week really strong. So now all of these red levels, we can just restart the drawing process. So support, this is now support from top to bottom. This is support on the week. And then this is, just going all the way down. That's it, right there. Now we want to see a retest coming into here a little bit, and then more forward movement. I mean, it looks good to me that that's kind of what's going to happen. We closed above the bear trap, or it's pretty much the bear trap. The bear trap is the long one right here, or the bull trap. Where we trap the bulls. So we pretty much, we could get one of these, but I think it's highly unlikely with how cheap the yen is. So it makes more sense to me that this trend will sustain and fill these gaps. Like this is probably like a quarterly gap, and this gap is going to want to get filled, and that has a high probability of bringing that 20% correction on the sp500 that we're looking for. Now, on a fast-moving basis, like this is what we were looking at, and we got above that trend pretty easily for the bear gap was a bear trap, the bear trap down here, and we hit the top of the moving average channel here. We wicked below the high of the bear trap channel. But that's pretty much that. There's not a whole lot to say other than that. The Japanese yen looks good, and that's not a good thing to say on if you're bullish the market. But if you've been saving up, you got some dry powder, hey, there's a high probability your time is coming for Christmas. All right. Go to the VIX. So one thing that's showing to me is that both, well, let's look at Japanese yen here. Yeah, not a whole lot of significance. We broke the H4 to the downside, so we're going to see some consolidation. But for the most part, this is now flipped to support on the week, so that's good. And now we want to see it test and hold as support. So for the most part, yeah, we'll just turn all these green. So that's just a sign of a lot of strength, where it killed all of these bears on the week. Okay, and then now going to the VIX. So here we could see moving average or trend lines. So I like this because it shows kind of where we're at contextually. Contextually, we're at the bottom. Unless this breaks, we're pretty much at the bottom, which coincides and has confluence with the Japanese yen strength. And that's what I like about this, is that it's really showing just kind of the true colors of what's happening in terms of a technical basis, which is this is now holding as supply. Supply is my blue box. Or demand. It's now holding as demand. That there is demand for the bullish side of the VIX. Now, how high it goes, who knows? It might only go up to here. But, I don't know. I think, so we look at 2020. I mean, we broke out. But for the most part, this is what we want to see. We want to see some kind of demand holding. We stopped out. We did a stop hunt on this demand. So this demand is no longer in play. It's this demand. This demand from on this candle is the one that's in play, and then this demand as well. So if I were to highlight the past demand here, it's technically right here, but we could put this whole thing right there. So that's and then if we want, we could. Yeah, I don't know. I think that's good enough. But for the most part, demand is holding, and we're at support, as we can see by the diagonal trend lines of the high and low in the week, and then this supply or this demand zone, specifically the open of this down low weekly close, it's above that. So price reclaimed to the upside, and we could expect higher movement on the VIX. And it's either congruence bias or it's just basically what I see in terms of confluence. Like, we want to see confluences because then it increases the probability. There are no certainties, there's only probabilities, right? But the more that we could see, the better we can act in terms of the right risk management. And so in terms of support and resistance, we're just in the middle. We haven't closed the week above weekly resistance, which is this up candle close, but we haven't closed below. And we're in this no man's land, but there is a higher chance that we could go higher just because of how low we are in the VIX. And then the current state of the market and just looking at the fundamentals, right? So that's pretty much it here. I'll highlight this because it's done. Videos to come. I'm going to break down the Charles Schwab thematic portfolio from 25 stocks to 10 for the robot revolution theme. The robot revolution theme, why I like it so much is because it looks like the best long-term trend play. So if I were to go look at some charts of just the thematic portfolio, so some of them I have to replace, like software as a service. I think there's been a company that's been delisted. That's kind of why it looks red. But if we go up here, I ranked the portfolios from best to worst. Water sustainability, it looks too parabolic. So this is the top market cap 9 stocks in the 25 stock portfolio from Charles Schwab for water sustainability. And then I divided those 9 stocks by the market. And that tells me, it shows me a pattern, and it tells me what's performing the best against the market. And if it's up and to the right, it's beating the market. And for the most part, if it's too parabolic, I think there's going to be some consolidation because it's moved too quick, too fast, and there's no pattern really. It's just trend, and then it's just a matter of time before trend breaks. And trend breaking is what you want. But the more of a pattern, the better. The basing, you want more of a basing effect, like kind of like this. When you see the basing effect, then you could tell like a big move is coming. So that's kind of the premise of just why I'm going into the robot revolution, which happens to be down here. So the ones in green, I think, are going to do well within the next so I'm going to preface this. I think it's 12, 11 years would be choppy. And I think there's these ones in green are good short-term portfolios, like 1 year horizon, 5 year, 3 year horizon. I think they're great. But in terms of like a 40 to 50, 30 plus year horizon portfolio, I think it's robot revolution. Maybe national defense too, but here's what I mean. So, and some of these in green might also be a good like 20 plus year, 10 plus year portfolio, like aging population or junk food or caffeinated drinks. I think could be a good 10 plus year portfolio. But it's, chemicals from natural gas, water sustainability, just for how fast they've moved, I think it's it can't be sustained. But water sustainability looks really good. Chemicals from natural gas looks really good. Aging population looks really good. I would buy whenever we have a huge dip or recession. By the way, caffeinated drinks looks good. We're at the resistance now, so I wouldn't buy it just yet. Just wait until a pullback comes, maybe a 20% dip in the sp500. Junk foods looks good. I don't know. Right now it looks kind of a little scary. I wouldn't touch it. It's at the highs. Robot Revolution. So this is the one that's caught my eye just because of the pattern. It's basing a lot, and it has it's making this thing called the bulldog, and that's the pattern. So if I were to take off the magnet and to draw the bulldog, it's a two-dimensional picture. So here is the tail. This is the back foot. It's a two-dimensional side profile. This is the back, front foot, and then this is the neck, and then this is the head, and it's pretty much a triangle almost, but it's a bull flag, and then we resume up. So it's a double bottom bull flag formation of a base or a cup and handle, whichever one you want to pick. But this kind of basing is good for like really explosive moves. And I think whenever we come to a big major recession like 2034 or 2024 or 2025, whatever those, the Treasury is hinting at a huge recession, like whatever, maybe it's that 2024, 2025, but around 2034, if you can get any major recession lows close to 2034. So the reason why I'm bringing up 2034 is because of the Euro-dollar futures curve on the cycle. So if I go to my sent mail, and then I want to show the Euro-dollar futures cycle. Here it is, right here. So here's 2034. It's the beginning of the green zone for growth. So I hear a lot of when I have some traders that work with me, and they were like, well, we had a really good growth of past 10 years to where the trading was easy. Well, that's because we were in the green zone, where interest rates were easy, money was easy, things flowed, and now we're into this risk off, I call it fragility zone, and to pretty much to where the market will have a huge range and will be choppy within that range, and it will give the illusion that we're having progress in the market, but we're pretty much ranging with really high highs and low lows, and we're capped on the growth, and it's just range bound. It's going sideways over a long period of time. And specifically the period of the fragility zone lasts, so the whole cycle from start to finish I think is 21. So 1991 to 2013 I think is 21. 2013 minus 1991. It's 22 years. So roughly 5 to 6 is the green zone. So 16 years of fragility, of sideways movement, of these highs and lows. So what I am saying that we could see the Corona nuke low again. But I don't think it's going to be this year or next year. I think 2034, 2035, 2024, 2025 is a good chance. 2034 is when I think we get out of all of that basically quote-unquote hell of sideways chop and lows and highs, range-bound highs. But yeah, for portfolio for 2034, I'm thinking based upon the pattern and the performance against the S&P 500 and just how good it looks. The news prints I'm seeing, like for example, Amazon, FedEx, wanting to get a robot in to unload trucks or to load shelves because they're having a hard time finding workers, and the whole demographic thing, the whole demographic trend. These companies want to stay in business, and they need to have the productivity done, and the best way is to have these robots, perform autonomously, and it's coming. And I see it in this graph, and there's two bullish patterns: double bottom, bull flag. And the thing is, I think this bull flag is going to base out until 2034. I think it's going to continue. Maybe we'll hit a major recession in 2024, 2025, or maybe 2028 or 2030. And then that will be the bottom of this basing here. And then 2031, 2032, 2033, 2034, we break out, and then that's what I think is going to happen. Not financial advice, of course, all entertainment purposes, but I think this is going to be pretty much the next FANG stocks. That's a bold claim, of course, and it's designed to, get attention and all that. So it's a little disingenuous, but I do think it has a good probability to be that. So it's not totally disingenuous. But I think this is kind of what I would do if I were to, obviously I'm in investing competition, so I'm going to use kind of what I'm saying, and you're going to have to wait 13, 14 years for me to actually put it into practice. But yeah, I'm putting in the time to make do some research to refine this stock list from 25 to 10. So the amount of that kind of investment shows that I personally think it's worthwhile to invest in making a video specifically about this thematic portfolio and trend. Will it be these companies that are the ones that are going to be flying high? Who knows? But I know that this trend looks good. The other trends look too parabolic. You want something that's got a lot of basing, and that makes sense with the long-term debt cycle, which is the year-dollar future cycle, which is 22 years long. We're currently in the fragility zone. The green zone ended in 2018, 2019, and we started the fragility zone, and we're expected to have in the fragility zone from 2 to 4 recessions. So that explains why we could form a bull flag here, where more downward movement here, but it still looks good for the long-term duration as long as we hold the back of the dog. And then it will form the handle of the cup and handle, and boom, that's it. That's Mark Minervini's basically strategy. His whole strategy is basically cup and handle patterns of explosive breakouts for 300+% for 3 years in a row. That's his record. I think it's 300% for 3 years in a row. It's Mark Minervini's streak. But that I'm basically taking his template. His template is basically finding companies that form cup and handles, a lot of basing for a breakout. His strategy is a breakout strategy, and that catches like a big trend, a big explosive trend. So that's going to be that video, and so I broke that down and made it really exciting. Experiments this week. I wanted this week from the 19th to the 23rd. I want to do some experiments with the NinjaTrader backtesting and the entry bot to see if it could do better than what I did without any interference, but just specifically just letting it run on a certain just one mode and see if it can beat me for this week. If a dumb bot a dumb entry bot can do better than me, then I'm doing something wrong. And we're going to try a whole bunch of settings. We're going to do regression mode. We're going to do trend mode, but that's going to be for the whole day. It's not going to modulate. But we're going to see, just to see like how well it can do. And it's only going to do scalps, just because it's just not smart enough to be able to do anything more than a scalp. I mean, it's just too hard to even calculate a more complicated strategy beyond scalps. 2 to 1. We could start it at a 4 micro scalp. I think that's 1%. Yeah, I think that's 1% with a 15 tick stop loss. So we'll try it, and then we're also going to do a test of a back test of the wide stop loss. Double the stop loss. Instead of 15 tick, 30 tick, break even, slow break even comparison test. And then I'm going to make a video how I'm building positions and building the equity curve, and then how I'm making entries to reduce my risk going forward. A more detailed video for my index. So that's basically it for the weekly overview.